The Nasdaq 100 just crashed more than 10% within the last few weeks. And here is the shocking truth. If you try timing the market now by selling your investments, you could be making the most expensive mistake of your life. Let me show you why. A $10,000 investment in the S&P 500 over 20 years would have grown to $64,844. That's a 548% return. But here is the devastating part. If you missed just the 10 best days in the market, your returns would drop to $29,700. If you missed 20 best days, you will only have $17,826. And if you missed the 60 best days, you would actually lose money, ending up with just $4,205. But here is what's really interesting. 7 of the best performing days occurred during a bear market. In fact, in 2020, the second best day followed immediately after the second worst day. And this is why trying to time the market is so dangerous. In this video, I'm not just going to tell you stay calm and hold your investment. Instead, I'm going to show you the psychology behind market crashes, the proven data about recoveries, and give you an exact strategy to turn market fear into your advantage. By the end of this video, you will understand why the biggest wealth building opportunities often come during the scariest market drops. Look, I get it. When you see your portfolio dropping, it feels awful. But here is something that changed how I think about my investments during market crashes forever. Imagine you are driving down a highway and you see your favorite store having a massive sale. Everything 20% off. Would you panic and run away? Of course not. You would probably get excited and buy more. Yet, when the stock market goes on sale, most people do exactly the opposite. Let me show you why this thinking is costing people millions. If you invested $10,000 and stayed invested for 20 years, you would have $64,844. But here is the crazy part. If you tried timing the market and just missed those 10 best days, you would only have $29,708. That is like throwing away $35,000 because you got scared. History tells us something amazing. Think about this. In any given year, the market usually drops about 14%. Sounds scary, right? But here is the wild part. Those same years typically end up with a 12% gain. It's like the market is testing our patience before rewarding us. Why market crashes are actually a good news for an investor. Remember, when you were a kid and wanted to buy something, but it was too expensive, well, the market crashes are like a store-wide discount on great companies. When everything is cheaper, your regular investment buy more shares. It's that simple. The practical here is exactly what to do during a market crash. First, have your emergency fund ready, which is 3 to 6 months of your necessary expenses. Number 2 is set up automatic investments. This removes the emotion that comes into play as an investor. Number 3, stick to your investment schedule. Whether it's weekly, monthly, doesn't matter. Whatever you are doing so long, just keep doing it. Think of it like filling up your car with petrol or diesel. You don't try to time with the petrol prices in the international market. You just fill up your car when you need it. Let me share 4 important things that destroy wealth during market crashes. Number 1 is playing detective, which means trying to figure out the bottom is like trying to predict the weather. You will probably get it wrong, so don't try it. Number 2 is portfolio picking, which means checking your investments daily during crashes is like watching the paint on the wall dry, except it's actually hurting you. Number 3 is panic selling. Remember, you only lose money when you sell. Everything else is just numbers on a screen as long as you don't book your losses. And number 4 is getting too clever. Trying complex strategies during crashes usually backfires. So don't try it. Keep your investing simple because the slow and the steady wins this investment race. Here is the simple truth. The stock market is the only place where people run away when everything goes on sale. The richest investor in history, for example, Warren Buffett, Peter Lynch, Charlie Munger, they all made their biggest gains by investing during market crashes. and not by trying to avoid them. Think about it this way. In 20 years, you will probably regret not buying during crashes way more than you will regret buying too much during a crash. So here is what I want you to do now. Number one is write down your investment strategy now before the next crash comes. Number two is set up automatic investments. Number three is keep some cash ready for opportunities in a opportunity fund. And number four is when market crashes next time, just stick to your plan. Remember, market rewards patience, not panic. The biggest fortunes are not made during bull markets. They are made by those who kept investing during crashes and had the patience to wait for the next bull run. Let me leave you with something that changed my entire perspective on investment during market crashes. Remember those numbers that we started with? A $10,000 investment growing to $64,844 over 20 years? That's not just a random statistic. It is a story of two types of investors. The first type sees a market crash and thinks, I need to get out before it gets worse. They sell their investments, sit with cash on the sidelines, and miss those crucial recovery days. 20 years later, they are still waiting for the perfect time to get back in the market. The second type of investor sees the same crash and thinks the market is on sale. They keep investing throughout the scariest of times. 20 years later, they have turned their $10,000 into nearly $65,000. And here is the fascinating part. Both investors faced exactly the same market crashes. The only difference was their response to the fear. So next time you see headlines about market crashes, ask yourself, which type of investor do you want to be? The one who lets fear drive their decisions, or the one who turns market fear into an opportunity? Because here is the truth about building wealth in the stock market. The biggest gains don't come from predicting crashes or timing the market perfectly. They come from having the courage to stay invested when everyone else is running away from the market. If you found this video helpful, I have got something even better for you. In my latest portfolio update video, I will show you exactly how I am navigating this market volatility with my own money. You will see my actual Invest Engine ISA portfolio, how my own Nasdaq position is up almost 70% despite the market crash, my diversification strategy across global markets, plus how I am using gold ETF as a hedge, which is up 25% only this year. Click the video on screen now to see my portfolio breakdown. You will also get a special bonus. Use my link in the description of the video to get up to £100 when you invest at least £100 and stay invested for 12 months. Terms and conditions apply and your capital is at risk when you invest. Also, I might get a small commission if you use my link to sign up to the Invest Engine platform. Remember, the next market crash isn't a matter of if, but when. The question is, will you be prepared to profit from it like I am? This is Dr. Suman, helping you build your wealth one step at a time. See you in the next video.